Welcome to Stocks in Translation, your essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. And today, I'm joined as always by Sydnee Fried, our producer. And this week we have JC Parets, very excited here, founder of Allstar Charts, also host of the morning show, also chartered market technician, also Miami native, born and raised. So this is going to be great. Thank you.
Also a wine lover.
Yeah, indeed.
We got a lot to get into here. So on the docket today, we're going to be talking about market leadership and how that is expressed through market technicals and what you can do with this information. And our phrase of the day, breadth, as in market breadth. Is it good? Is it bad? Anyone got the cure? We will discuss. And this episode is brought to you by the number 2, which happens to be the age of the current bull market as of this Sunday. How time flies. So, JC, Sid, let's talk about the story of the day. We got stocks at record highs, and full disclosure, we're taping this in between CPI announcement and the Fed decision. We don't know what it's going to be, but fortunately, we got Apple, stealing the thunder here. We got Apple at record highs. Once again, the biggest stock in the solar system. What do you think about large cap tech as the, as the modern market leader here?
I mean, you've got 3 companies that are worth over $3 trillion.
That's 9 total for just 3.
It's 3 companies, right? How do you like that, China? Huh? We got 3.
Yeah, no Saudi Aramco there.
Hey, come on. No, it's a big deal. So you can't ignore that. And then here's the bigger picture. People are like, well, it's out of control, technology, blah, blah, blah. When you go back and you study every bull market in history, you know what you're going to find? You're going to find that technology was a leader and an outperformer in pretty much every single one of them. So the fact that that's happening this time too is not really that unusual. It comes back to sector rotation and, what's going to be the additional leadership, because it's not just tech. Last year, it wasn't just 7 stocks. It never was. That was just bad math, and most people never even bothered to actually count. It was definitely never just 7, ever, right? And it's not just a few names now either. So one of the things that I would look at is consumer discretionary, because when we think about tech, let's understand that tech is a lot of Apple and Microsoft, and even in the indexes, NVIDIA is a far, far third, right? But like Google and Meta are in the communications index. Amazon and Tesla are in the consumer discretionary index.
So even tech isn't truly tech, or just strictly speaking tech. I want to ask you about energy. I saw you tweeting about XLE. This is large cap energy. As you know, it's banging up on multi-year highs here. And to add to your point before, tech is usually the leader, but historically, sometimes energy has been number 1, not in over a decade. 2013, Exxon ceded that title to Apple. But what do you think about energy right now and WTI crude?
Yeah, so you look at the XLE, for example, and we're still below the 2008 highs. I remember that vividly because everything else had already rolled over. The only things working were energy, some transports, and some ags. That's it. And the XLE is still below those levels. One thing that I will point out, though, is that if you look at the New York Stock Exchange oil index, which the New York Stock Exchange, it includes a lot of stocks that are not from America, right? The New York Stock Exchange has a bunch of big ADRs that don't make the XLE, that are more US-centric. So if you look at the more global US oil index or the New York Stock Exchange oil index, you've got the foreign companies as well. And look at some of these Canadian names like Imperial Oil. They are above the former cycle's highs. The New York Stock Exchange oil index is above so I look at that relative strength and I'm like, well, what's the difference between the two? Well, the difference is that there's foreign stocks in this one and there aren't in that one. So when I think about energy, that's how I'm thinking. And then the other thing is, people don't own it, right? 3% of the S&P 500 is energy. 2% of the Dow's energy. 0% of the NASDAQ is energy. So people don't own it. So when you look at historical weightings in the market, we are at coming off, we were down 2% in the S&P, right? So we're coming off of just extremely depressed levels as an overall weighting of investor portfolios. So I continue to think that mean reverts, maybe into the high single digits, maybe into the double digits. And I think that's going to happen over time. Because remember, these are not, one thing we know about energy and commodities in general is that when you go back and you study all of them, none of them are 1 or 2 or 3 years. All of them are 10, 20 years, right?
That's the cycle of commodities.
That's just what it is. So, that mean reversion, I think probably continues for a long time. It's a process. We're 3-4 years in, ever since crude oil traded below 0. That was the end, right? That final puke, literally. And we've reversed ever since. So, we're 3-4 years in, it probably has legs.
All right.
JC, my question is, tech is the sector that everybody talks about, right? And it is a leader.
Marin, see what happens, of course. Right off the bat, boom, we're going.
Don't make fun of my home county just yet. My question is there a sector that could turn into the leader that is not tech one day, or is it going to be tech forever and always in whatever next AI iteration we see?
Yeah, tech leading is a characteristic of a bull market, right? So standard, right? So no surprises there. The underperformance from consumer discretionary, which let's remember is represented by a lot of Amazon and a lot of Tesla. That's consumer discretionary on a market cap weighted basis. Consumer discretionary coming into today, what day is it today? Wednesday?
Yes.
Today is Wednesday the 12th, I believe. Yeah.
Not to date the show, but yes.
Yeah. Coming into today, consumer discretionary was down for the year on a total return basis. Down.
Yeah.
So down, Dana, right? Down, right? I think that to see some rotation into consumer discretionary, if this is in fact a bull market, which many signs point to that it has been and continues to be a bull market, is consumer discretionary really going to crash further than it already has, underperformed for so much, or are we going to see rotation into those areas? And my suspicion is we're going to see some rotation into those areas. So, today we were selling puts in Tesla. We are looking to buy Amazon on a breakout. Those are the areas there's been a ton of relative strength. And so in consumer discretionary, you have these very bifurcated situations where you have like Wingstop and Texas Roadhouse.
There's a lot of bifurcation in the industries. Yeah.
And then just like the bad ones, so that's a really interesting area.
Yeah, I'm waiting for XLY to break out definitively to new highs, but as a lot of other sectors have over the last couple of years, it's just a laggard. So we'll see what happens with that. Want to get to our word of the day, which is breadth. And market breadth analyzes, this is according to Investopedia, analyzes the number of stocks advancing relative to those that are declining in a given index or stock exchange. For example, positive market breadth can occur when more stocks are advancing than are declining, and it suggests that the bulls are in control of the market's momentum. So this confirms price in the index itself, so it confirms price. And it's the opposite for negative breadth. And I will add that breadth can be measured in a number of ways. You could take the number of stocks that are advancing minus the ones that are declining. That's called the advanced decline line. You can measure stocks, the percentage of stocks above the 200-day moving average, above the 50. And I know this is something you look at. So how do you think about market breadth?
Yeah, I mean, I think it's important for investors just to remember that this is a market of stocks, right? It's like, oh, what did Dow do today? And the Yellen and this guy, right? Like, it's a market of stocks. There's a bunch of stocks on the New York Stock Exchange. There's a bunch of stocks on the NASDAQ. You have to, and then remember what types of stocks are in those indexes, right? What is it, like half of the largest 100 companies on the New York Stock Exchange aren't even from America, right? Like you've got a very diversified group there, a lot more cyclicals in the New York Stock Exchange. In the NASDAQ, you have a long tail of very low quality junk that the New York Stock Exchange simply does not have. So you've got a lot more. So when you think about market breadth of the NASDAQ, remember what stocks you're looking at. Like there's a lot of garbage in there that doesn't matter.
Can I just say that what I really appreciate, JC, is that you know what you're talking about, that you've looked into the composition of these indices. You're not just repeating stuff you hear. You understand what you're talking about, and you come to your own conclusions. So thank you for that. But let me, Sid, I know you had a question.
Yeah,
I interrupted.
You mentioned the Dow, and I had to jump in there. You are not shy talking about the Dow. You talk about it a lot. Why do you stick with the Dow? You kind of have called it the most important index.
Yeah,
I call it the People's Index.
It's the blue chip People's Index.
It's a good way to put it.
Yeah.
When I was younger, and yeah, sure. I'm in my 20s, and I want to be Mr. Cool Guy. Institutions follow the S&P 500.
I say that all the time.
Yeah. The institutions, right?
That's what we do.
Of course. I get it. And, I learned from Ralph Acampora, shout out Ralph Acampora, used to say, JC, don't fight Papa Dow. Don't fight Papa Dow. And you know what I used to do? I used to fight Papa Dow all the time because I thought it was too cool for school. And boy, I was dumb and ignorant. Let me tell you something. These are 30 stocks. It's very, very simple. If you want to know the direction that the market is going in, up, down, or sideways, look at those 30 stocks. That's it. Are more of them going up? Are more of them going down? Or are they going sideways?
That's breadth right there.
Very simple. 30 stocks.
Okay, but is the way that it's calculated outdated?
This is one of those things where in theory maybe it is, but in practice it isn't, right? You
Don't
know what I'm
mess with
saying?
Papa Dow.
If you overlay the S&P 500 and the Dow Jones Industrial Average, take it back to the beginning. What was 1957, if my calculations are correct for S&Ps? How am I doing? Yeah, pretty good.
For the 500, it was somewhere in there.
Yeah, so calculate and put both lines over each other, put them in different colors, and you won't be able to tell me which one's which. I know I certainly couldn't. Right? Maybe if I look close, I could figure it out, but I literally do this for work. But nobody's going to know the difference. They go up together, they go down together. So if you want to know the direction of the market, you got 30 stocks. Listen, you could be crazy like me and go through all 500 or all 3,000.
Yes,
we do
the
that
Russell
too,
3000.
right? But if you don't have the time to do what we literally do for a living, 30 stocks. That's it. Once a week, Saturday morning, Friday night, Sunday morning, Monday morning, whenever your routine is, go through those 30 stocks. Are they going up? Are they going down? Are they going sideways? And you're going to have a good idea of the overall direction of the market. And let's remember something. Why do we do this? Because we know for a fact that asset prices trend. Right? It's not random. It might seem random, but it's not. Asset prices trend. We know, we have the math. So if we know that, then why wouldn't we want to spend time and attention looking for trends? And if you can identify the direction of those 30 freaking stocks, it'll take you 10 minutes, maybe 5.
We're going to pause right there. We need to take a quick break. I want to move on now. This episode happens to be brought to us by the number 2, and that's because this is the second anniversary of the current bull market, as you've been writing about, Sunday. And this gives us a chance to talk about the Fed. They got a meeting going on right now, but it also gives us a chance to talk about the bull market. And this is something that's very controversial on X, formerly Twitter. And there's a lot of, maybe you might say, antagonism towards the media definition, which is 20% off of the lows for the bull market. What do you think about this whole mess?
Well, I've thought about this a lot over the years, and we've done and gone back and done the math, and there is nothing at all valuable about the number 20.
Yeah.
It's completely irrelevant.
So you did the test, and that's what you determined.
It's funny what one can learn by actually going and counting. It's really valuable stuff, I got to tell you. And we've gone back and looked, and there's nothing magic about the number 20. So you could throw that out the window. What really is in a bull market, what happens in a bull market? You got more stocks going up. Yeah, thanks, JC. Yeah, you got more industry groups and sectors that are going up, making new highs. You have indexes that cover those, are making new highs. You have more countries around the world participating, also making new highs. That's what a bull market is. When that happens for a period of time and you're not seeing the opposite, you're not seeing new lows, you're not seeing that, that's a bull market, right? Stocks are going up, right? The number 20, I don't know where that fits in that relationship, right? And what else do we know about bear markets, right? You don't have a lot of stocks going up. You don't have a lot of industry groups going up. You have one specific group of stocks or industry groups that are the worst that particular cycle, whether they're those growth stocks, like those ARC names and stuff like that, or in other periods it was home builders and financials, and other periods it was technology. Like every cycle has that group that is leading it lower, but you don't have a lot of stocks making new highs. Most things are making new lows, and until that stops, that's the bear market. That's how we look at it.
I have a question for you. I mean, obviously today focuses on CPI, focuses on the Fed. That won't necessarily change today or even maybe tomorrow. What's something that you're watching in the markets that is not getting enough attention? That's not Powell that everyone's focused on.
Yeah, I mean, listen, there's been a pretty strong relationship there for a minute with the dollar and equities overall. And when the dollar, this has been going on for years, and when the dollar has been strong, that's tend to come with stocks under pressure. And while the dollar has been weak, that tends to come with stocks doing well, not just domestically, but around the world. And while we have seen some corrections underneath the surface, I mean, the NASDAQ fell about 8% top to bottom. S&P and Dow fell almost 6%. You had 8% down from consumer discretionary, small caps down double digits, transports down double digits. So there were corrections this year. But generally speaking, the resiliency of equities, not just the U.S., but globally, despite the stronger dollar, and emerging market currencies have gotten crushed recently. The strength in a lot of these countries around the world is really, really interesting, and in the United States as well, for that matter. But it's just stocks. I don't think it's getting enough coverage.
Interesting. And, you mentioned the relationship between the dollar and stocks. What about bonds and stocks? Because that's something, that relationship can change given where we are in the business cycle, and that itself can be in flux. But what do you think about the relationship between stocks and bonds right now?
The guy who put it best, I want to give a shout out to my man, Steven Weitzel. He's a financial advisor down in Atlanta. He's the man. And he said it the other day. He was calling it Pavlov's new dog. Like, how many times is it going to take, people who have been trained in a certain way to finally come around that, that cookie, I'm not like an expert in psychology, but my understanding is like the bell,
yeah,
and
they
the
salivate,
dog.
something
right.
like
So
that.
just generally speaking, asset allocators tend to think of that 60-40 stock bond portfolio and have been trained like Pavlov's dog. So shout out Steven Weitzel. The way he put it was Pavlov's new dog. Like, how many times is it going to take these financial advisors to get it through their heads that 60-40 now equals 1? It's 100 now, So thinking about the different correlations to get that diversification, perhaps in commodities being the new 60-40, versus bonds, right, against stocks, has been the better trade. And the joke or whatever, or the thought process is, how long is it going to take for a lot of investors to come around to that new
Until everybody
dynamic?
Does it the new way that works, and then it won't.
When everybody agrees that was a dumb idea all along, then it's probably a good idea again.
Yeah,
Contrarianism.
yeah.
It brings up something. You and I talked about this in a webinar that we did a couple years ago. We talked about magazine covers, how they can be contrarian indicators, how a new ETF class can be a contrarian indicator. We just got spot Bitcoin ETFs in January of this year. Maybe that meant something, maybe it didn't. But talk about how, as a market contrarian, how you can use information like this to help you get an edge.
Love you, Jared. Just throw me alley-oops. That's it. That's it. He knows how to get it, right?
We're here for the
I want to
quotes.
throw an alley-oop.
Just throws me alley-oops. No, I mean, listen, there's nothing magical about it. The guys over at Fidelity gave me a tour years ago of their Fidelity chart room, and they have this massive chart with like all the old magazine covers overlaid on a massive chart.
Yeah, you described it. It's amazing.
Sick. It's amazing. So, it's really just a function of the environment, right? By the time, the journalist kind of gets a good understanding of what, investors are thinking about and talking about, because journalists do a very good job of figuring out what people are interested in talking about. So by the time that people are talking about something and the journalist figures out that that's what they're talking about, and then they write the article, and then they submit the cover story,
Takes
and
time.
the cover art gets approved. By the time that damn thing hits the shelves, we're probably a little late in that party, right? And that's what we've seen. And it's not just a magazine, but we want to look around, right? What else is happening? And sentiment is very, very difficult to quantify. I think we do it as good as anybody, and we know it's not perfect, right?
Mm-hmm.
And there's others who do a very good job, and they know that what they're doing is not perfect. It's like an imperfect aggregation of what society is thinking. And, what I think people overthink it is that it's usually somewhere in the middle. It's usually not at an extreme. It's when it's at extremes that we want to really pay attention. And those magazine covers tend to really show up near those extremes, I'll tell you that.
I love that story every time. All right, we got to make room for who wore it better. Yes, this is one of my favorite parts of the show. Today we have Binance token versus Shiba Inu token. And if you're following us and you want to chart these, it's BNB.USD, that's a ticker on Yahoo Finance, and SHIB-USD, that's Shiba Inu. Now, here's the spiel. Arguably, both of these securities were left for dead by some with the FTX meltdown that happened, rocked the crypto world in 2022, but both have more than doubled their price this year, up more than 100%. And to boot, the major domo of Binance, CZ, just went to prison. But that's closure, right? Maybe investors are just realizing that the worst possible event risk is in the rearview mirror. So balance all that with Shiba Inu, named for the same breed of dog that's featured by Dogecoin and suffering the loss of the world's most famous Shiba Inu, Kabosu, who expired at the ripe old Doge age of 14 recently. And importantly, we want to note that we're not asking you to compare Dogecoin, it's Shiba Inu, to Binance token. So, what is it, Shiba or Binance?
Well, let's just remember, Shiba is like the silver to the Doge being the gold of the meme token,
So silver being the utilitarian case.
Silver being the junkier, crazier version of the blue chip Doge.
I can
right?
remember that.
But if you're going to go down that route, just go full degen and just go further down the cap scale, and you're going to get so much more relative strength. Binance is in another category altogether where I would include it in the big four with Bitcoin, Ethereum, and Solana. And granted, it carries a lower weighting, but it is very symptomatic of the cycles themselves. And if you take an equally weighted chart of Bitcoin, Ethereum, Solana, and Binance, you're really going to get a good look as to how those cycles have shifted over the years.
I love that you've done this, number one, but yes. Sorry to interrupt.
Why wouldn't we?
Well, I've tried to construct sentiment indicators based on crypto tokens. I got up to about 50 and it seemed like I was going nowhere. So I got stopped in my tracks. But if you have done that and gleaned some useful trading information, hats off.
Well, let's remember. So to answer your question, Binance definitely wore better because Binance's real market capitalization, we're talking about $30, $40 billion is what its increase in market cap over the last year. Like you said, it's doubled. The Shiba is up, 8? That's like a GameStop, that's a GameStop, right? So like if you're gonna go Shiba, I think you gotta go down to like a Floki or a Bread or something like that, Pepe, whatever you're into.
We should have done Shiba versus Floki. I missed that opportunity there. But
there's always future, we can do this again.
We can do this again. All right, so it sounds like you're leaning towards Binance token.
All day.
And then also, CZ going to jail. Like I said, that event risk being in the rearview mirror, they've already gotten fined. It looks like that's behind them. If that didn't shut down Binance, it looks like, well, it's going to take some future event, I would say.
Yeah, I mean, Binance is like pushing, making it actually closed at a new all-time high the week he went to prison, which is, that's like the halving happening on 420. This is a simulation, right? This keeps happening.
Sold.
We're definitely in a simulation. Here's my question for you. Help investors wear it better. We talked a little bit about 60-40 earlier. How can investors who are not in on crypto yet, how should they get in now? What's the best play?
Listen, the way to do it is really just get a good understanding and get your hands dirty, right? Like that's really how you learn things. I'm very incredibly fortunate to have very successful friends in venture capital and technology. I lived in California like you, so I know these people. And one thing that they always taught me was you got to play with the toys. Just get your hands dirty, even if you lose a few bucks because you spent too much money on whatever visual thing, iPad you stick on your face, but learn, play with the toys.
Very nice. I want to ask you one more. We're going to alternative assets, investing in wine. Give us a breakdown, your favorite bottle currently or ever.
As an owner of a winery.
As an owner of a winery.
Yeah, I'm not really an investor in the wine. I like to drink the wine and make good juice.
Well, that was just my way in.
Yeah.
Alternative assets.
I would love to. No, it's funny that you said this because I've been having a lot of conversations about this because there's certain tax benefits in investing in agricultural products. So if you get a big check, for whatever reason, there are ways to take advantage and do smart things with that money that include, buying first growths and things like that and just putting them away. You don't even take delivery. You just own, essentially an NFT. I mean, it's definitely not, but it's essentially a representative of your ownership, and you can take delivery if you want. I didn't know anything about wine when I lived in New York, and then I moved to Sonoma, and I started learning a few tricks, and you start hanging out at wineries, and the barrels, how much those barrels cost, all right, and then the yeast, huh? All right. So you start learning a few things, and it's like, we could do this, and we can make great juice, and our 2021 Cabernet, I promise you, I can't wait to bring you guys a bottle. It is delicious. It is. And my worst nightmare is making bad wine. If I made bad wine, I couldn't live with myself. I would just throw it in the river. No one's drinking it.
We've got multiple reasons to invite you back here.
So good.
Love it. We do have to wind things down here. Before you go, I'm just going to leave you with this. May all your powder be dry and your account balance stay high. That's all for now. Stick with Yahoo Finance.